Hi, in this particular video, I want to look at fiscal policy under macroeconomics. What is fiscal policy? What is fiscal policy? Fiscal policy refers to the manipulation of government expenditure and taxation in the management of the economy. So fiscal policy has got two major instruments that government uses to manage the economy. That is government expenditure and taxation. So under this discussion, I want to look at government expenditure and taxation as we cover our fiscal policy instruments. Now, government expenditure and taxation also affects government budgets. Government raises its revenue via taxation, and that's the revenue that government needs to spend on its various programs. So let's start looking at the two, government expenditure and taxation. I start by looking at government expenditure. What is government expenditure? Government expenditure may mean capital expenditure or revenue expenditure. So what is capital expenditure? Capital expenditure is government spending on investment goods or government spending on non-current assets. For example, government building hospitals, schools, and roads, etc. Those are expenditures on non-current assets or expenditures on investment goods. That's government capital expenditure. What is government revenue expenditure? Government revenue expenditure means the day-to-day spending by government. Government spending on things like salaries and stationery, that's government revenue expenditure. So that's the difference between government capital expenditure and government revenue expenditure. So continuing to look at government expenditure, government uses the fiscal policy through the balance between government expenditure and revenue. So what are the uses of the fiscal policy? So government can use fiscal policy to reduce high levels of unemployment, or government can also use fiscal policy to control inflation. So fiscal policy can be used in two major dimensions. Number one, to reduce high levels of unemployment. Number two, also to control inflation. So let's start by looking at the first use of fiscal policy to reduce the high levels of unemployment. How can government employ fiscal policy to reduce high levels of unemployment? As I've already said, fiscal policy has got two major instruments. That is government expenditure and tax. So how can government use its expenditure and tax to reduce the high levels of unemployment? For government to reduce the high levels of unemployment, government must carry out what is called expansionary fiscal policy. Under the expansionary fiscal policy, government must reduce taxes and increase its expenditure. This will increase the levels of demand in the economy. However, if government is to reduce taxes and increase government expenditure, the resultant budget will be a deficit budget. Why? Government raises its revenue from tax. So if taxes are reduced, it means that government revenue will be reduced. So if you reduce government revenue, at the same time increase government expenditure, logically you have a deficit budget. The difference in the budget is what is called public sector net cash requirements, meaning that government must borrow to cover the difference. This is the borrowing that is called public sector net cash requirement. It's the amount of money that government requires to meet its budget. So if we see an increase in the public sector net cash requirement, it's a sign that government is following the fiscal policy to boost the economy. Fiscal policy is uh, uh, expansionary fiscal policy is aimed at reducing unemployment and boosting the economy by putting more money in the pockets of people. When you reduce taxes, you are increasing people's disposable income. How do we calculate the disposable income? Disposable income equals to personal income minus tax. So if tax is reduced, people's disposable income tends to increase. And at the same time, if government is increasing expenditure, then government is pushing more money in the pockets of people. Demand is going to increase in the economy, and the end result is that firms will also increase their output, thereby requiring more resources, and more people will be hired, and so levels of unemployment will be reduced. How can government use fiscal policy to control inflation? How can government use fiscal policy to control inflation? To reduce the levels of inflation, government must carry out what is called contractionary fiscal policy. Contractionary fiscal policy is the exact opposite of an expansionary fiscal policy. So under contractionary fiscal policy, government does exactly the opposite of what it does when government is carrying out an expansionary fiscal policy. Contractionary fiscal policy, government must reduce its expenditure and increase tax. When this is done, the resultant budget will be a surplus budget. So the contractionary fiscal policy is also called deflationary fiscal policy. And if you have a surplus budget, government can then use the surplus to pay back the loans that were borrowed, or the amounts that were borrowed when government was carrying out an expansionary fiscal policy. However, reduced government expenditure means reduced levels of demand in the economy, and that's what helps the prices or inflation to go down. That's government expenditure under fiscal policy. Now let's look at taxation, which is the other part of government fiscal policy instrument. What is taxation? Government revenue comes from taxation, of course, and that's one of the major reasons why government charges taxes, is to raise revenue. However, there are other reasons why government can charge taxes apart from just raising revenue. For example, government can charge taxes to control the consumption of demerit goods. What are demerit goods? These are goods that are deemed not fit for consumption or not desirable for consumption. Goods like beer and cigarettes can be considered demerit goods. So for government to control the consumption of demerit goods, government may tend to increase taxation on these goods in order to make them expensive or unaffordable for everyone. However, the other problem with these demerit goods, some of these demerit goods like beer and cigarettes are quite addictive. So even if the prices were to go up, people will do whatever they can do to buy them. Number two, government can use taxes to protect infant, strategic, and declining industries. How can government use tax to do that? Government can use or introduce indirect taxes such as customs duty and other tariffs to restrict the importation of certain competitive goods in order to allow the infant industries and strategic industries, even the declining industries, to thrive. Number three, government can use taxation to put into effect an automatic economic stabilizers. This is done during the periods of recession and boom. So in the period of recession, government can employ an expansionary fiscal policy in order to push for economic recoveries. And in the period of boom, government can employ a contractionary fiscal policy in order to run a surplus budget and pay back the loans that could have been borrowed when government was using or employing an expansionary fiscal policy. Number four reason for taxation is to equitably distribute income and wealth in the economy. This is done by government charging higher taxes for the rich, and of course using the money raised from the rich to help the poor in the economy or in society. That's about taxation. Principles of taxation, of course, comes from Adam Smith, who described what he called the four canons or principles of taxation. These are principles of a good tax system. So any good tax system must have the following principles. Number one, equity. Equity means that tax should be levied according to the ability of a taxpayer to pay. So levy tax according to the ability to pay. The rich people have more ability to pay than the poor, so charge a higher tax for the rich and a lower tax rate for the poor. An example of such a tax system that brings in equity is the direct taxes, such as pay as you earn. If you are getting a certain amount of money, the tax is zero. The moment you go beyond that tax bracket, you are charged a certain percentage. You go beyond another bracket, you are charged a higher rate of tax. So under equity principle, taxpayers or tax must be levied on the ability to pay by the taxpayer. Number two principle of a good tax system is certainty. Tax should be unavoidable. At the same time, the taxpayer should know when and how the tax should be paid. There should be certainty as to when and how tax is supposed to be paid. In other words, the taxpayer is not supposed to be confused as pertaining to the dates of paying tax and how that tax should be paid. Number three principle of good tax system is conveniency. The tax should be convenient to pay. You are not supposed to waste the taxpayer's time in queues and other processes. Make it easier and convenient to pay tax. That's another principle of a good tax system. The last principle or canon of good tax system is that the tax system or the tax should be economical to collect. Tax should be cheap to collect. The whole essence of collecting tax is to raise revenue, so it's not supposed to be expensive to collect tax. Now let's look at the classification of taxes. There are three major classifications of taxes. Number one, progressive tax. Number two, regressive tax. And number three, proportional tax. Let me start with the progressive tax. The progressive tax is the tax that takes an increasing proportion of income as income rises. So as income increases, the proportion of income that is supposed to be paid as tax also increases. In other words, the percentage of the tax rate goes up as income increases. A direct example of such a tax system, such a tax, is the direct tax. For example, pay as you earn. The rate of tax increases as the person's income increases. Number two classification of tax is regressive tax. A regressive tax is the tax that takes higher proportion of a poorer person's income. Takes higher proportion of a poorer person's income. A good example of a regressive tax is an indirect tax. For example, VAT. VAT is a regressive tax because both the poor and the rich are paying the same amount. First of all, VAT is the tax on the product, the tax on expense. So both the poor and the rich are paying the same amount. If you convert that same amount to the proportion of the income, you'll find that the poor is paying a higher proportion than the rich. For example, if the VAT is 10 kwacha, you are paying 10 kwacha. Both the poor and the rich are paying 10 kwacha. They are paying the same amount. If you compare 10 kwacha to a person who is earning 100 kwacha, that's about 10% of that person's income. But a 10 kwacha compared to a person who is earning 1,000 kwacha, that's about 1% of their income. So you'll find that the more income, the higher the income, the lesser will be the percentage that is paid as tax. This is the reason why it's called regressive tax. The third classification of tax is called proportional tax. Now, this is when the tax is the same proportion of the person's income. If it's 10%, it's the 10% of the poor's income, the 10% of the rich people's income. They pay the same percentage. The difference between direct and indirect taxes is that a direct tax is a tax on income, a tax on profit, or a tax on wealthy. Example is PAYE, corporation tax, capital tax. All those are examples of direct taxes. An example of an indirect tax is a tax on expenditure, that is taxes such as import duties or customs duties and value-added taxes. Now let's look at the Laffer curve. Government revenue comes mostly from taxes. A Laffer curve named after Professor Art Laffer shows how tax revenue and tax rate are related. So in this graph that we have here, we will notice that this line, the vertical line, represents the tax revenue that can be raised. And the horizontal line, this line, horizontal line, represents a tax rate. Now, if government charges a 0% tax, it means that government will have zero revenue. No one will pay tax because tax is 0%. If government charges 100% tax, it means that no one will be willing to work because there is no incentive for working, and so government revenue from tax will be zero. So at 0% tax, government raises zero revenue. At 100% tax, government is likely to raise zero revenue from taxes. So Laffer curve shows that government can achieve very high taxes if government charges the taxes in between 0 and 100%. And to be specific, Laffer suggested that if government will charge a tax rate of 25%, they are likely to raise a higher revenue, and if they charge 75%, they will raise a higher revenue. Now 25% means that more people will be willing to pay tax because tax is cheap. At 75%, government will be taking larger proportions of income from those that are paying tax, but the problem is that few people will be willing to pay tax because tax will be very expensive. Tax rate will actually discourage hard work if the tax is high, is a higher rate. So the recommended average tax rate at which government can maximize its revenue is 25%. I have said government can maximize revenue at 25% tax rate and 75% tax rate, but because a tax can discourage hard work, the 25% tax rate is more preferable. That's about fiscal policy. That's about fiscal policy. So let's just look at what we have done so far. We've looked at fiscal policy and we've looked at the fact that there are two major instruments that government uses under fiscal policy. That's government expenditure and taxation. If government is running an expansionary fiscal policy, government increases government expenditure and they reduce taxes. and this will result in a budget deficit, meaning that government now must look for extra monies. Government must borrow to finance the budget. If the government is running a contractional fiscal policy, government reduces its expenditure and increases taxes, and that will result in a budget surplus. Thank you for your time.